Good afternoon, everyone. I am Preeti Jha, Senior Manager in Strategic Alliances at One Finance. Today, the topic for the masterclass is personal and home loans. Now, I'm sure everyone at some point or the other either might have taken some sort of loan or would want to or might need to take a loan in the future. Now, it's always best to have a deep understanding of topics like this, especially where your money is involved, by some sort of expert. And for this same purpose, today with us, we have our guest, Mr. Parijat Garg. Sir, hello, sir. How are
Hello,
you?
very good. Thank
So
you for having
first,
me.
so first of all, thank you so much for coming here. I just want everyone to know that Mr. Garg comes with more than 2 decades of experience in the field of credit, lending, risk management, and many more. Sir, first of all, I just want to say that I'm sure a lot of people often come across this fact that, okay, I know what loans are, and I'm sure it is some sort of I have to repay, and there is some interest and all of that. But often people don't know very minute things about it. And
Absolutely.
I'm sure you must have also experienced something like this. So,
Very,
would
very
you,
personally.
yeah, would you want to share your experience with this?
Sure, sure, absolutely. So, in fact, it happened with my father when he took the first loan for home loan.
Right.
He just took the loan and forgot about it.
Okay.
And 3 years later, I started looking into his finances. And then I realized about this home loan. And I realized that the interest rate that he started with and the interest rate that is applicable today
Okay.
was already up by 2%.
Over.
And that was costing several lakhs more in terms of interest outflow.
Right.
And then I had to sit with him, work with him to make sure that things are better off.
Correct.
And after that, I took control of that loan and I started managing it.
Exactly.
So somebody very close to me, I
Right.
could see that money getting lost because
Exactly.
of some ignorance.
Right, exactly. That's what I was also trying to say, that often people don't understand how much you need to know, especially like I said, when your money is involved, you don't want to lose money simply because you were not aware about few things, right? So I just want to say that we are all very excited to get some expertise and knowledge and guidance from you so that we don't make any such mistakes in the future.
I look forward to that.
Right. So just before we start, I want everyone to know that our masterclass is live on our website, on our YouTube channel, and on our LinkedIn and Twitter pages as well. So whichever platform that suits you the best, feel free to continue there. By the end, at last 10 minutes of this session, we will keep for Q&A round. So whatever doubts you have, whatever queries, feel free to put it down in the comments section. And by the end, we will try to address all of them.
Absolutely.
So over to you, sir.
All right. Thank you very much. Namaste and good afternoon. So today, what we will do is we'll talk about this very interesting topic of loans, and we will focus mostly on two type of loans which are most popular: personal loan and home loan. And we'll talk about that. And the next thing that comes in is how do we become eligible for either of these loans? What kind of rates, charges, fees that can become applicable for anyone whenever you are applying for these loans. And that is very important because that is where you lose out on your money. How does or how do these loans actually impact on credit score? Because once you take these loans, if your credit score has an impact, it can actually impact what you can do in future. So that's where we'll understand that aspect also. And we will understand few important strategies that you can take care of when you're making the loan repayments, because these strategies not only can make you save money, can make you much smarter investor and a smarter finance manager yourself, right? So these are the things that we will cover. And if you have any questions beyond these or within these, as we mentioned, you can put it out in the comment box and we'll take it up towards the end of the session. All right. So with that, let's dig into the first one, which is personal and home loan overview. Right. So here, personal loan and home loan, I think most of you would know. Personal loans primarily are unsecured loans. When we say unsecured, essentially it means that there is no collateral, there is no security. And if I have to compare that to home loans, you are taking a loan to buy or construct a house or a property, right? And when you do that, there is the house or the property that is taken as collateral, right? That's why a home loan is taken as a secured loan. And the why we do take personal loans? Personal loan we take for many reasons. One could be that we don't want to specify. We can take just personal loan for any kind of consumption, right? We want to buy something in the house, maybe a furniture, an electronics material, or we have some extra expense coming in because it's festival. We have to shop for gifts for our family. So आप वो कर सकते हो. Or you might want to travel abroad, right? And उसके लिए भी 1-2 लाख का खर्चा हो जाता है. So then travel loan is also an unsecured personal loan. And many of you who are young are looking to get married. आजकल शादियां भी सस्ती नहीं है, right? So marriage loans or wedding loans are also unsecured loans, right? You can take a loan. Of course, it's not necessarily advised, but if you need it, you can definitely take it. And unfortunately, we also face some medical emergencies in our families, and in such cases, also if you have shortage of money in your emergency fund or through your insurance, in that case, also you can bridge that gap by applying for a personal loan, right? So these are the reasons why you would take personal loans, and typically the loans range between 50,000 rupees to 10 lakh rupees, and we'll talk about more on where and how you can take that. In case of home loans, like we said, it is mostly for either constructing or purchasing a house. And the tenure, which means that how long the loan would have to be repaid, could be minimum 5 years and 30 years. And most people, like even me, हमने सबने like we've taken it for maybe say 15 years or 20 years. That's the sweet spot. But if you need it for more than 20 years, you can take it. If you need it for 10 years, also you can take it. And yeah, I think we'll move forward from here. Okay. So in personal loans, I think we spoke about some of the personal loans of different nature. Travel loan we spoke about, wedding loan we spoke about, medical loan we spoke about. Consumer loan is essentially when you're looking to buy any product, any electronic product or any service. Maybe you are taking, let's say, a service like, say, maybe like let me take example of product itself. So you're buying a television, which is like 7 lakh rupees, or you're buying a refrigerator, which is 30,000 rupees, or like if you're in Mumbai, heat always troubles you, so you want to buy air conditioner, right? So in that case, air conditioner would cost you 35-40,000 rupees. So in that case, you can take a consumer loan to buy that product. Education loan is also unsecured loan. Many of us, especially people who are in the current era, we know that skilling is very important. So AI, ML, Gen AI, Chat GPT, these are new skills that everyone is trying to learn, right? And for these skills, you have to take courses. And these courses are not necessarily very easy on your pocket, right? So you have to spend sometimes 25,000 rupees, sometimes 50,000 rupees. If you're taking a certified course, it could cost you 1.5 lakh rupees also. So those kind of skill courses are also can be covered through personal loans, and that's where this education loan or a skill loan can come in handy. Now, where can you get personal loan from? Most obvious answers are banks, NBFCs, right? Cooperative banks. But there are several digital lending platforms that have come in, right? These are called fintechs, in other words. So you can explore them. These are like very quick. You can just download it on a mobile app and look at it. But one thing that you have to be very sure of, that there are very many spurious or illegal lending apps also available. So whenever you download an app, just be very careful what that app is, right? You look at their reviews, understand there is rating around them, and only then take loan from them, because you can also get caught in frauds there. There are some online loan aggregators, which are also called as marketplaces. So anything we hear as loan bazaar kind of places. These places will give you comparison of personal loans between, say, a different bank and NBFC. So you can easily compare what will you get, what is your eligibility, and then you can take easy decisions. They themselves don't give the loans, but they help you connect with banks and NBFCs. Peer-to-peer lending platforms. Peer-to-peer lending platforms are also giving personal loans. These are loans where an individual is giving a loan. So if I need money, I can actually approach someone. Instead of approaching someone directly, I go through this platform. They help me connect with another individual who may have, say, 30,000 rupees to give me loan. and if they agree with my purpose of the loan, they can give me the loan. So these loans are typically cheaper than the NBFC loans and others, but you have to be very careful in terms of what you're doing, what kind of charges or what kind of fees are applicable, and we'll talk about that in the coming slides. Similarly, when we're looking at home loans, right, that's the other side that we're trying to know about today. There are variety of home loans, right, and these are, you can see many terms, but essentially these are all related to home. So that's the core concept here. Home purchase, which means that you're going to a builder or a developer and buying a house or an apartment which they are building, right? So that's is home purchase. Or you can do it in resale also. Suppose there's another person who already has a house, he has been living in that house for say 5 years. Now that person wants to sell it to me. In that case also, I can take a home purchase loan because it's still a ready-made home that I'm buying. The second one is home construction loan. In this is an example where I might have a plot or a land, maybe ancestral, or I might have invested several years back. Now I want to construct a house on that particular plot or the land. In that case, I can go for a home construction loan. Now the difference here is that in home construction, typically I am appointing a contractor for building the house, and that is being done only for me. In case of home purchase, I'm part of an entire residential project which might have, let's say, 300, 500 houses. So the bank or the NBFC has already done a study about the entire project, the feasibility of it. They would have pre-approved the entire project, and mine is just a unit within that. So the processing time in home purchase loans will be much faster because it's much easier. They have already pre-approved the property or the residential project, and mine is just a unit approval in it. But in case of home construction, they have to look at it completely from point zero because they need to understand whether I own the land, there is no legal issues around it. So that's why it takes slightly more time. So if you're going for home construction loan, take a little more buffer for you to get the loan approval. Now, when we're looking at home improvement loans and home extension loans, so essentially these are where you already have taken either a home purchase loan or a home construction loan, and then you're going for something additional on top of it, right? Why would you go for something additional? You will go something additional because I actually got the possession of the house in 2018. Now it's 6 years, and I can see some degradation in the house where the paint is peeling off, or there is some issues in the house, and I want to do some sort of enhancement, some renovation, some improvement in the house. In such cases, I will go for a home improvement loan. So this will typically be for lower amount. Maybe home purchase loan could be 50 lakhs, 70 lakhs, 1 crore, 2 crores. Home improvement loans would be typically 5 lakhs, 10 lakhs, 20 lakhs, because that is the improvement that I would want to do in my existing loan. And it could also be for a house that I'm living in for last 30 years, 40 years, and I want to do some enhancements there. In that case, obviously the value of a home improvement loan would be higher. Home extension loan is that I constructed a house. Earlier, I constructed only the first floor or the ground floor. Now I want to go maybe add another floor on top of it. Right? In such cases, then I need to go for extension. So I'm extending the house, or I'm taking like maybe the outer side of my house into the constructed boundaries. Plot loan is where I'm just purchasing a plot. There's no construction involved, and I want loan to do that. And these are being approved by very, very few lenders. Most lenders don't prefer this, but these are like the most popular ones. Balance transfer. What do you think? What is balance transfer? So, as the name suggests, balance transfer is transferring of balance or transferring of home loan from one lender to another lender. Right? Maybe first time I took the loan from an NBFC, which could have been at say X percentage. Now after 3 years or 5 years, I find this lender two, which is a bank, which is giving me a better rate. So I just shift loan from this lender to this lender. That's called balance transfer, and we'll talk more about it in our strategies. Okay. Now, who do you get home loan from? Very similar to personal loans. You can get it from banks. You can get it from NBFCs. There are very specific NBFC or category of NBFCs which are called housing finance companies. Right? When you look at their names, the names that themselves will say HFCs or housing finance companies, right? That's where you will get this. And very similar, you also have cooperative banks. These cooperative banks are similar to banks, but they can also offer you housing or home loan. Okay. Now, the question that comes in is, if I want to take home loan, should I go to a bank or to a housing finance company? Right? These are the two most popular categories of lenders who give loan. Almost 80-85% or 90% of the loans given today are given by either the bank or housing finance companies. Right? So as a customer, I need to decide where do I approach. Right? And these are the comparison. Like banks, as we all know, typically have more stringent documentation requirements. So if I have very clear property title, if I know everything about the property, the ownership of the land on which the house is being constructed, my entire credit history is very good, everything on my document, in my income, everything is fine. In that case, typically I will approach a bank because that's when all the stringent criteria will get through. But when I'm looking at housing finance companies, they will take a slightly relaxed approach. Right? For example, um, in semi-urban areas, if you're say in a town, sometimes the property that you are living in may not have a very clear title. It may not be very clearly known who's the owner because it's coming from the family. So there could be three brothers who actually own it, but there's no proper document there. It may not be registered properly because the property has been coming down the family for last 100 years. So the history may not be very clearly known. Now, in such cases, bank might take more time, or they may be very very stringent. They may ask you too many questions. But if you want loan, possibly a housing finance company can be a friend to you in that case. Now, because banks are very strict, you can see the rate of interest is also lower. Right? Housing finance companies will be slightly higher. But अगर आपके documents में थोड़ा बहुत ऊपर नीचे है, so you can understand that usually your rate of interest will be a bit higher than what you will get otherwise. Um, Now, this is very important. As we all know, interest rates change every quarter or every 6 months or every year, depending on when Reserve Bank of India, the central bank in India, they change the rates. Based on that, a bank or a housing finance company also changes rates on loans as well as on deposits. Whenever that change happens, a bank is likely to pass that interest rate benefit to you as a customer faster as compared to housing finance companies. So, for example, now in the next 6 months or next 1 year, we are expecting the rates of our home loans to start coming down. Right now, the rate could be say around 9% on an average. Maybe in 6 months' time, we expect it to come down to 8.75 or maybe 8.5, depending on when RBI starts to cut the rates. Whenever that happens, maybe in case of bank, it may show effects on your loan records within say 1 month or within let's say 2-3 months. Whereas in case of housing finance companies, it may take slightly longer. So one has to, if you're taking loan from housing finance companies, one has to be more proactive personally to make sure that you're getting benefits of interest rate drops. In case of bank, you can be slightly more relaxed because they will themselves pass on those benefits. And banks, because they are more stringent, they may not be approving loans so easily if you are in the lower income brackets or your income is not through formal channels. When I say formal channels, you're not getting salary into your bank account, right? Maybe you are earning salary, but say maybe you are working in a housing society and you get cash being paid, or you might be working with a decent business person, but they may not be paying you salary into your bank account. They might be paying you in cash. You might be getting 40,000 rupees, 50,000 rupees salary, but since it's in coming in cash, you would be accounted for in informal segment. And for a bank to give you loan is possibly unlikely. And therefore, in those situations, going to a housing finance company would start to make more sense. I hope this gives you a good sense. If you get a good sense, please give us a thumbs up in the comment box and so that we know that you're getting this right. And if you have any questions on this, definitely put it in the comment box and we'll try to address that towards the end of the session. Okay. So I think we covered how to make choices a bit and comparison. So two more important points here. That one is that of course housing finance companies offer more flexibility, which we saw why they are more flexible. So and they're also more flexible in giving you loan terms. For example, you may want like a specific type of EMI construct because you find it difficult today, or you might want more financing than what a typical bank would do. So suppose your house costs 50 lakh rupees, a bank might give you only loan of only up to 40 lakhs because loan to value ratio, the LTV term that we use in this space, will be 80%. But in case of housing finance companies, maybe they might be able to give you 85% or 90%, which means that you might get 45 lakh rupee loan on 50 lakh housing property value. So in such cases, you may prefer housing finance companies in comparison to a bank. Right? And also banks don't usually cover the stamp duty and the registration costs. A lot of us know whenever we have to buy a house, it's not just the value of the property the builder has quoted, right? On top of that, you have to pay stamp duty, you have to pay registration cost, and don't forget, you have to also cover the cost for interiors and other products that you have to buy to furnish the house. So वो तो एक अलग ही पूरी कॉस्ट है, राइट? So वो तो आपके पास खुद आएगी, जो कि आप शायद अगर आपको जरूरत है तो you can take personal loan to cover those. But stamp duty and registration costs, which could be anywhere between 5 to 7%, 8% in different markets, वो cost भी significant cost. If you're buying a 50 lakh rupee house, this could mean 2.5, 3 lakh rupees, which could be substantial when you're buying a house, right? Up because आप घर खरीदते हो तो you're all in. So if you take it from HFCs, they might consider that in the value of the house, and that can also get financed. So अगर आपको उतना finance की जरूरत है, do your math, consult a consultant or a counselor who can actually advise you on this if you have confusions. But do keep this in mind that you have an option. If you need money to cover this, housing finance companies can come to your help. ओके, सो ये तो अपन देख लिया कि लोन्स कहाँ से मिलेंगे ना, हाउ डू वी गेट लोन्स, राइट? नाउ वी हैव टू लुक एट लोन एलिजिबिलिटी. Are we going to be eligible for not, right? And what does a lender look into it? So lender looks at many things, and this is typically common for personal loans and home loans. Except for the part of property, everything else remains the same, right? One is that they will look at age. Why age is important? Age is important whether you would be a person who will be employable by the time the loan is in action, right? So if I'm taking a home loan, which is for 20 years, and I'm already say 55, then most banks will know that I would not be able to earn beyond the age of maybe 60, 65 at best, right? So a banker will not be able to give me a loan of more than 10-year tenure. Right? But if I am, let's say, a 25-year-old or a 30-year-old who's looking for a home loan, in that case, I can easily get even a 30-year loan because I can definitely work for another 30 years till the age of 60 to be able to repay the loan. So that is where age becomes important. Income, we all know why it is important because आपके पास पैसा नहीं है तो how would you repay, right? So you have to have income, you have to have a stable income, and you are working in a sector which is likely to keep improving, which is going to be relevant, because only then you will be able to repay the loan over a period of time. In personal loan, this is less important because personal loan is maybe 12 months, 24 months, 36 months loan. So I just look at like a 2-year or a 3-year horizon. But in case of home loan, I have to look at 15-year, 20-year horizon to understand whether the person will have income and also an employment stability, right? These two also go hand in hand. Fourth point, credit score. I think we have all heard enough of that, right? Credit score is very important for any kind of loan. If you have good credit score, you're likely to get loan. If you have poor credit score, you will struggle to get a good loan or at good terms. And we'll speak more about that in the next few slides. Debt to income ratio, right? This debt to income ratio sounds like a complicated term, does it? Debt meaning what do you have, what kind of loans do you have currently, what kind of EMIs you are paying currently, what kind of credit card bills you are paying currently. All of that goes into debt. And income, of course, we know what is your disposable income. So when we're looking at income, disposable income means that what is net of taxation. So maybe my CTC could be 12 lakhs, but what I get in hand today is 9 lakhs. So, so then my income is considered as 9 lakhs. You don't look at the full income, you look at the post tax or the post deduction income. And when I'm looking at debt, I'm looking at what kind of EMI. So maybe I have a car loan because I'm using car, which I took say 2 years back. So I'm paying an EMI of say 15,000 rupees every month on my car loan. In such case, that will come as my debt, and this will come as my income. So what a bank or an NBFC will look at is that if I have a disposable or net income of 90,000 rupees every month, if my EMIs are already crossing 40, 50,000 rupees before I took this home loan or personal loan, then they may not approve my loan. But if my ratio is less than say 40% or so, then they may consider me. Right? And by adding this new home loan EMI, if I'm not crossing say 50, 55 or 60% of my net income, then I'm likely to get that. So that is the idea. That is how you look at the debt to income ratio. Okay. So maybe we are eligible. We prepared ourselves for being eligible. Now we have to give a variety of document for any lender, which could be a bank or an NBFC or a housing finance company, to evaluate us. So one is proof of identity. So proof of identity typically is PAN, the permanent account number, the tax ID. So that is the most common proof of identity that everyone takes today. Right? Along with that, Aadhaar card is another great proof of identity. So most lenders will ask you for PAN or Aadhaar as proof of identity. This helps us them understand who you are. So your name, your date of birth, and your photograph is being looked at from proof of identity. From proof of address, the banker wants to understand where do you live, how long you have been living in that space, and are you going to stay likely to stay in that space or not. For that, if you have an owned property, then ownership of that house that you might be living in, maybe it is your ancestral house, it is owned by your parents. In that case, also it's fine as long as it is within the blood relative. That can be given as a proof. Or if you're living in a rented place, then a rent agreement, which has to be registered, will be required as a proof of address. And you can give electricity bill or say a postpaid mobile bill also as an additional proof to give more comfort that you have other kind of services which are coming on the same address. So those are the things that will be required as proof of address. Income proof will typically be salary slips if you are salaried, or if you are running a small business, then in that case, your ITR would be required. Your bank statements will also be required. So these two will give a sense of income proofs, income ITR proofs, as well as bank statements will give that sense. Now, for employment proof, if you're salaried, you have to give a salary slip, also maybe a letter of appointment or a letter of confirmation from your employer that you still work at that same employer. So that can give the employment proof. In case of home loan, this comes as an additional requirement, which is the property related document, right? Where you have to give what kind of property you're buying, whom you are buying from, what is the current value, so some sort of a cost estimate around that, so that a bank can then understand that better. And when the bank goes deeper, then typically they will reach out to the developer who might be building the house or building the residential property, and they will ask them to give the proof of actual land, the actual ownership. There's a whole lot process, which as a customer you may not need to get involved as long as the residential property has been pre-approved by a particular bank. That should be your right choice. So if you like the house and you go to the builder, you speak to their office, they will tell you that okay, these three lenders have already pre-approved our project. So then your first preference should be to go to those three, because then your requirement of property related documents will be very minimal. Your time to approval for your home loan will be much faster. All right. Okay. Let's move on. Okay. So now we have a poll for you. So whenever you're thinking of loan, now we come to this important point of the numbers, right? And this poll is when you are thinking of taking a loan, what's the first thing that you prioritize? Do you prioritize loan amount? Do you prioritize interest rate? Or do you prioritize the repayment flexibility? Right? When you look at loan amount could be that somebody is giving me 10 lakhs, somebody is giving me 12 lakhs. Or interest rate, is it like somebody is giving me 12 lakhs, but the interest rate is maybe 0.5 higher? Would I go for loan amount, or would I take a 10 lakh rupees at a lower interest rate? That's the choice that we are trying to talk about. Or where can I repay faster? Where can I close the loan faster? Right? What could be the prepayment possibilities? Which are these that you would opt for? Okay, so let's see what your responses are. Please, this must be popping up on your screen. So please give your preferences. We usually get like very very interesting results, and it'll be interesting to know what is going to be your choice: loan amount, interest rate, or um, repayment flexibility. Uh, okay, so I can see some things in the choices in the comment box. Yes, quite interesting. So I think Viresh is saying C, Stevie is saying B. So C is repayment flexibility. Someone is saying interest rate. Vijay Ram has given like B, C, and A. So interest rate is my first choice. Loan amount is my second choice. Repayment flexibility is the third choice. Um, Preeti saying all. Say it would have been easier to get all, but that's always the most difficult part. How do we get all together? That's a little difficult. So yes, it's a interesting one. Um, shall we move ahead? Okay, all right. So let's see interest rates and charges, right? Ideal world, we want everything to be balanced, but the real world, there has to be some balance between what we get. Right? Ultimately, it's a combination of all three. Right? When we look at personal loans, because these are unsecured, the rates are typically higher, and you can see a huge range starting at 10.5%, going up to even as high as 26%. So 26% is pretty high. And that I think is the most challenging aspect of it, right? So why this difference? Because there'll be customers who have great credit scores, who have good income, banks will be after them and they will get it at the lowest rates. But if you have poor credit score and maybe your income levels are also moderate, in that case, a bank would always prefer to charge you slightly higher, right? And that's where you will get 26% also. When looking at home loans, the range is very minor. Right? Why it is minor? Because the loan amount is much large. And here it ranges from 8.4 to 10.75%. And this keeps on changing as we discussed, like whenever the RBI changes the rates. Now, two important things here. One, many banks today give an option of adding a women co-borrower, right? And in home loans, we see that most people prefer a co-borrower, two people taking the home loan or three people taking the loan, right? These are like very common things. Now, when you take that, there is a possibility of getting some discounts on your interest rate because there is a lady in the as a borrower, right? And that is to promote more or more women in the house, which could be your mothers or your wife or possibly sister, who might also be a co-applicant and a co-borrower on the home loan, and you get a discount on your home loan interest. So do consider this whenever you are applying that. It is not only to just save money, but also to empower women in our houses, right? So to bring all of them into the participation of loans. And also another aspect for you to look at is that when you're comparing, banks will typically be on the lower side of this rate. Housing finance company will be typically on the higher side of this rate, right? And we discussed how do you choose. So whenever you choose housing finance companies, you have to always assume that you will be on the higher spectrum on this rate. All right, let's move forward. Let's look at what kind of rates that banks and housing finance companies offer. Right? And some of you may know this, and some of you may find this very complicated, but they are not complicated. Once we go through these one by one, you will clearly understand what it means. Fixed interest rate, as the term indicates, fixed. It's fixed for the tenor of the loan. So if you have taken a house loan or a home loan for 15 years, whatever rate that you decided upon at the time of loan disbursement by signing the agreement, that stays constant throughout the tenor of the loan. That is for that 15 years. You have an option of paying fees and getting it changed, but that's a slightly complicated process. But otherwise, it will remain fixed. Floating rate means that it is going to fluctuate. Like the word floating means when you're on water, your boat will keep swaying. Similarly, the interest rate keeps getting swayed. Now, why it floats or how it floats? Because it's linked to the market rate that RBI announces. So RBI, like we were discussing, every quarter announces a base rate or a reference rate. Now, most of the interest rates are a reference on top of that. So typically, if say RBI rate is about 6.5, a bank will say it will be 6.5 plus 2.5 is what is going to be your floating rate. So that's how you get it at 9%. Now this 6.5 tomorrow increases to 7%. So then it will become 7 plus 2.5, which will make it 9.5. If by chance, like and what we anticipate in the coming 1 year, the 6.5 RBI reduces it down to 6.25, then your interest rate, because it's floating, will come down to 8.75%. Right? So it can go up, but it can also come down. That is the benefit of floating, that it is always market linked. For during the years, 20 years of your loan tenure, there'll be years where it will be going up, there'll be years where it will come down. So on an average, you might get something different, but that is what you need to be aware of. Now, how do you choose between fixed and floating? When the interest rates on a long term basis are at the lowest. Suppose, say, next 2 years, the interest rates in the country for home loans come down to 7%. Now, you believe that 7% is very low. It is very unlikely that any rate will go beyond 7% ever in 20 years. That is the time you can lock in and get the advantage of a fixed interest rate because you've locked in. Even if the market interest rate goes up to 8%, 9%, 10%, you have the best advantage of being at 7%. Right? But when it makes sense to be floating, when you are unsure where the market is, the market is at all-time high of interest rate, market is somewhere in between, it's always better to be on floating because then you take advantage of the market direction where the market moves accordingly your interest rates also move. So that's when you choose for floating interest. Most people go for floating interest rates because you're very unsure. But like I said, if our interest rates hit down to say 6.5, 7% for home loans, maybe that is a time you can definitely consider fixed interest rates. But do get a consultation, do your calculations before making this choice. What is hybrid rate? Now, hybrid rate is a interesting proposition from some banks and some housing finance companies. What they do is for first few years of your loan. It could be 1 year, it could be 2 years, it could be 3 years, depending on the plan, depending on that product proposal. They will keep a fixed rate. What does this give to the customer is a comfort that next 3 years, मेरी EMI fixed है. Nothing is going to change. It's going to be fixed. So मेरे को maths नहीं करना है. And after say 2 years, when the fixed period gets over, it will convert to floating. So this also is a good proposition if you want your first 2 years to be a fixed where you don't want to worry about it. Even if the rates go up in the market, bank will not change it. They will continue to be giving you the loan at the same rate which was signed at the time of sanction. So this could also be a good proposition for someone to consider. Like I said, do your calculations before you decide what kind of rate to choose. If you're unsure, usually go for floating interest rate. All right. Now, this is very, very important term when we look at home loans. It's a term called amortization. How many of you know amortization? Please put it in the comment box if you know about amortization and what does it mean. Let's see how many of you know. Put a thumbs up. Okay, so it seems that very few people have good understanding of amortization. So amortization is actually a schedule of your repayment. When I say schedule of your repayment, so if you take example of home loan, since it's a 20-year term, now in 20 years you are actually paying loan over 240 months, right? 12 months into 20 will make it 240 months. So you will be paying 240 EMIs bare minimum, right? That's the idea. Now, when you do that, every month you are paying some EMI. Suppose for simplicity, we start with an EMI of 10,000 rupees. Now, when I pay 10,000 rupees, this 10,000 rupees has two components. One component is called principal, the second component is called interest. Do we all understand what principal means and what interest means? So, principal means that if I have taken a loan of 50 lakh rupees, that is the principal amount, right? That is what a bank definitely needs. And on top of that, I'm going to pay an interest amount of say maybe 30 lakhs, 50 lakhs over a period of the loan tenure, which is what bank finally recovers, and that's what their income is. So the interest is what they earn from. Now, they usually, one would expect that if I'm paying 10,000 rupees every month, first the bank will settle it for principal and then they will settle it for interest. But that is not how it works. Bank will take some amount towards the principal and some amount towards interest every month that you pay the EMI. Now, in the first month, the interest component will be the highest and the principal component will be the lowest. What it means is out of 10,000 rupees, maybe almost 9,500 will go towards interest and only 500 rupees will go towards principal. So your principal from 50 lakhs will reduce only to 49 lakh so and so minus 500. That's what it will come to. In the second month, again, it might be 500 rupees of principal repayment and 9,500 of interest payment. By the end of the first year, this may change to 9,000 rupees of principal payment and maybe 1,000 rupees towards the 9,000 rupees of interest payment and 1,000 rupees of principal payment. So what you're seeing here is in the initial year, your principal is reducing very, very slowly, but most of the money is going towards interest. And that is why a lot of us end up paying a lot of interest on our home loan because home loan is for 20 years. For first 5 years, you are paying mostly the interest. Very few amount is going towards the principal repayment. And how do you understand this? This you understand through an amortization table. So whenever you take home loan, before taking the home loan, you can discuss with your bank or NBFC, ask them to give you your amortization schedule or an amortization table. There are websites on internet where you can go, give your loan amount, give your interest rate, give your tenure, and they can give you an amortization table. And you can very clearly see how much is going towards principal, how much is going towards your interest. And you would clearly see initially it's very small principal repayment, mostly interest repayment. Last years of your loan, it will be mostly in principal payment and then a few interest repayment, right? And this is very important when you're looking at loan repayment strategy, and we'll come to that later. But understand this very clearly. Go and read on the internet also. Try it out on your calculators, and that will give you a lot of understanding. Okay. Now we talked about fixed and floating, and now you'll kill me that okay, I'm introducing another term, flat and reducing balance. So too many terms around interest, right? But it is important for us to understand. Fixed and floating meant fixed for tenure, and floating meant linked to the market rate. Flat interest rate and reducing balance rate means that the interest is calculated at the start of the term, and irrespective of how the repayments are done, your interest amount is fixed that you have to repay to the bank. In case of reducing balance, based on what kind of payments that you're doing through the term of the loan, your total interest component over the tenure of the loan can change. And let me give example here. And we have taken this for a personal loan, but it can be extended for home loan as well. If the flat rate is 12%, and the reducing balance rate is 16%. By just looking at these two numbers, one would think, and people who responded on the poll, that interest rate is most important, they will go for 12%, right? Because 12%, 16% mein one will actually choose 12%. But if this was a flat rate on 2 lakh rupees, your EMI will be 18,667, which is more than the EMI that you will pay in the reducing balance rate. And at the time of 12 months, you will be paying 24,000 rupees as the total interest on 2 lakh rupees. Whereas in case of reducing balance, you are actually paying only 17,754. So you're saving nearly 5,500 rupees, even though the rate of interest looked higher, mainly because the way it is calculated. The difference here is that amortization example that I gave you. That in the first month, when I pay 18,000 EMI, maybe 3,000 rupees was reducing my principal, or maybe 5,000 rupees was reducing from my principal. So the second month onward, my interest will be calculated based on 2 lakh minus 5,000. Whereas in case of flat rate, second month interest is also calculated based on 2 lakh only. And that's why if you just multiply 12 into 2 lakh, it will come to 24,000. But in this case, if you multiply 2 lakh into 16, it should have been 32,000, but actually it comes to 17,000, because it's in a way a reverse compounding, right? It's going the other way around. So like in case of market, you look at a compounding benefit, you keep investing, your money keeps growing. Similarly here, because you are making the repayments, it's a reverse compounding, because you're paying every month, you actually keep saving on your interest. So that is where reducing balance starts to make more sense. And within home loans, you have daily reducing balance and monthly reducing balance. So many of the housing finance companies give you monthly reducing balance, and some most banks give you daily reducing balance. So between the two, again, you should choose daily reducing balance, because that will give you benefits of daily effect of your repayment as compared to a monthly effect on your repayment. So that's where this concept of flat and reducing. I hope you got it. And if you got it, please show a thumbs up on the comment. And otherwise, we can definitely address your questions in the Q&A session. Okay. So now I think we explained something. Let's see how much you got it through this poll. When choosing between a fixed and a floating interest rate, what would you prefer? Would you prefer a fixed interest rate in the current era? Would you go for a floating interest rate, or would you go for a hybrid rate? Okay. So you must be seeing the poll on your windows. Please give your options, and let's see how many of you got that. A for fixed interest rate, B for floating interest rate, and C for hybrid. Whoever are joining from Twitter, please put it on the comment. And for others, you must be seeing it as poll. So I can see quite a few are responding as floating. So thank you, which means that you are getting the sense of what we're talking about here. And I hope it is enriching you and will help you make right decisions. Okay, so most of the responses, at least I see in the chat window, are towards B. All right. So yeah, I think even the responses I see, almost 64% are saying floating, 23% are saying fixed. Okay, so fixed is also a decent choice, especially in personal loans. You can make fixed choices, but in case of home loans, in the current environment when the interest rates are high, I would definitely recommend not to go for fixed rate. Right? Okay. All right. So let's move forward. Okay. So we spoke about the interest rate so far. There are some other charges that one has to be aware of, and there are some processing fees that one has to be aware of. Right? Typically, the processing fees could range from 0.25 to 1%. This is for home loans. In case of personal loans, it can even go higher. Sometimes it can go even to 2%, 2.5% as well. Right. So, as customers, um, you have to be very careful. In personal loans, you don't have time to negotiate. But in case of home loans, you can definitely negotiate. If you have good credit score, good profile, definitely speak to your bank or HFC and try to negotiate on the processing fee. There are some seasonal benefits, like say sometimes during during Dashara, during New Year, during March end, you get special offers on processing fee. So do wait for that and try to get benefits of lower processing fee at that point in time. This is many times banks also give like a rounded number, saying that okay, even if you are taking a 50 lakh rupee loan, instead of charging you 0.25%, I will charge you just a flat 20,000 rupees or something like that. So you can negotiate either in flat terms, absolute terms, or you can go in a percentage terms. Also, there are other charges, like there could be an application fees, which many times could be processing fee. Sometimes it could be on top of the fees. So do ensure, especially in the digital platforms, be careful about that. For properties, you have legal verification fees and a technical evaluation fees. These are also substantial at times. It could be 50,000, 60,000 rupees, depending on the value of the property. So do understand these also, and you can also negotiate with your banker whenever you are finalizing your choice of lender. Stamp duty and registration, as we spoke about, these are fees going to government. You can't do much about it. There are schemes by government sometimes in the last quarter of the year when they discount this. If you are in that tenure where you're actually trying to buy a house, do take advantage of that. But otherwise, these are fixed. You can't do much about it. So, but you should be calculating that while you're budgeting your plan. On all of these pieces, you end up paying GST. So factor that in, because those will also be at 18%. So don't think about it if the fees is 5,000, that's it. It's 5,000 plus GST. So you have to think about that whenever you are doing that calculation. I will come to prepayment, but in case of home loans, usually there is also an insurance attached. Why a bank or a housing finance company attaches an insurance? Because they want insurance on your life, on the life of the borrower. Because it's for 20 years, some unfortunate event can happen within the life. And if that happens, the home loan can go into default from a bank's perspective. And in that case, they prefer that there is a insurance that is there on the life of the customer, especially in the first few years of the house loan. And that is where this insurance comes in. If you already have a home loan, a personal insurance for yourself, you can actually present it to the bank and say, okay, I'm already covered. The second thing is that they also want insurance on the property, because property can also get damaged because of fire and many other things, because that's the security. In such cases, you can also tell the bank that I will take it directly, I don't want to go through you, and because you might then find a better deal. So do evaluate those options while you are taking this. This is most important piece: prepayment and foreclosure charges. Now, in case of personal loans, prepayment and foreclosure charges are usually there, and in many cases, you're not allowed to prepay or foreclose. So these could be very high there. But in case of home loans, especially with banks, you have zero prepayment and zero foreclosure charges. Even with housing finance companies, if you have chosen for a floating interest rate, prepayment and foreclosure charges are zero. You can close at any point in time. That's the beauty of choosing floating rate. But if you have chosen a fixed interest rate, many players or many lenders have some charges as prepayment or foreclosure charges, because they are giving you a benefit of fixed interest rate. So when you're choosing your interest rate, also see an impact on prepayment and foreclosure charges alongside. And that is also another important decision factor for you. Okay, so we spoke about interests, rates, we spoke about charges. Now we are coming to credit score, which is an important parameter for us to understand how it impacts, right? So there are two places how it impacts. One, once you have taken the loan, how it impacts afterwards. The second is, what is your credit score and what kind of loan terms that you get upfront, right? That is important, right? So in personal loans or in home loans, in both cases, this is very important. In home loans, it becomes more important. There are many banks and housing finance companies today. They have published on their websites, in their marketing material, that if a person has a certain type of score, say maybe above 750, they can give, like say, a 0.05 discount on the interest rate. If they have score of more than 790 or 800, then maybe you get a 0.1% discount on the interest rate. In home loan, you can imagine if the home loan is for 1 crore rupees, running over 20 years, even a 0.1% discount on your rate is very significant. So do ensure that if you're buying a house or planning to buy a house, say in 2025, check your credit score today. If your credit score is, say, suppose 740 or 720, work on improving that. Take it above 750 over next 6 months while you are searching for a property. Because by doing that, you can save money on that interest rate discount as well, right? And do make sure that you are also checking it for your co-borrower, not just for yourself, because this is applicable based on the score of both borrowers that are coming on the home loan. And if you are actually lower than 650, then most likely you may not get it from a bank. And in that case, you have to go to housing finance companies. And as we had seen, you would be on the higher spectrum of the interest rate, which could mean 9, 9.5, 10%. And that obviously puts you into a difficult situation because your EMIs will be more, and your tenor will be more, and your total interest outgo will be much more. Right. Okay, let's move forward. Okay. Now, how can it get affected? So once you've taken the loan, you have responsibilities also to maintain your credit score. So maybe when you took the loan, you were at 750. But what could happen is that if you are missing on your loan EMIs for some reason, there are some bounces, you're defaulting not just on your home loan, maybe your home loan is all good, but maybe you're defaulting on your credit card repayment or you're defaulting on your personal loans, which are not with the same bank. The banks also keeps reviewing your credit score every 6 months or every year after you have taken a home loan. And if they see that you are defaulting on other loans, they may actually change your floating interest rate, or they may change your terms because they are seeing you now as a riskier customer who's defaulting on other loans. So do understand that banks don't stop looking into your profile only when they take the loan, when you take the loan. They also keep looking at it every few years. So do make sure that your credit score remains good, and for that, make sure that you're repaying on your other loans and other credit card payments. Right? Also, whenever you are applying for loans or whenever you're deciding to close your old accounts, especially the credit cards, do consider if your credit card is giving you good results, don't close your oldest credit card, because the oldest credit cards always have a positive impact on your score. So do consider that. When you're applying for loan, whether personal loan or home loan, don't go and apply at 10 places, because every time a credit inquiry happens or a loan inquiry happens, your credit score can drop by a few points. So do make sure that you first do your study, select maybe two or three banks or housing finance companies that you want to apply. Good, create a good mix. Maybe you take two banks, one housing finance company, or one bank or two housing finance company in your choice. Compare them for their amount that they can give you, compare them for interest, compare them for charges, compare for the schemes, what kind of benefits will they give you. Take some feedback from your friends who may have taken loans from these institutions. Once you, so that you are, first do all that study and only then apply. That would be my recommendation. Okay, so now we come to the most important aspect, which is the loan repayment strategy. This is like the most important aspect of it. So we'll go forward from here. Um, because that is something which will give you a good perspective of where you are placed in terms of your EMI repayments, how your interest rate payment is going, how your principal payment is going. So that will give you a good understanding of this, right? And along with that, create your own budget. Don't do more spends. Plan for what would you do for home furnishing. If you can delay some things to next year or year after, stratify them so that you're not spending everything upfront. Keep some money in emergency funds so that you have plans and it's not disrupting your EMI payments. So these things will ensure that you have enough budget in hand. Also, if you have good savings, you can plan to use that saving for some prepayment. So if you believe that every month I'm going to save 5,000 rupees from my salary, keep it aside. Whenever I have 50,000 rupees, I can go and prepay on my home loan and reduce the principal. Do remember, whenever you pay this 50,000 rupees on prepayment, it directly reduces your principal. It does not go towards your interest. So that has a very positive impact on your total financials. So do consider this principle as an important aspect. And if you understand the amortization schedule, you will understand the prepayment as well. Foreclosure, in case of home loans, I would definitely recommend that don't necessarily look at foreclosure very early on. Um, Home loan is one of the cheapest and a good source of capital. It has interest rate benefits also in the tax calculations as well. So do avoid foreclosure as such. You can definitely look at prepayments, but avoid foreclosure. You can plan and stratify, do mathematics, do your calculations to understand if foreclosure is giving you any financial benefit. Otherwise, continue your home loan as much as possible. Definitely, you don't have to consider continue it for 20 years. You can bring it down to 10, 12, 13 years by some other strategies that we will recommend. Balance transfer is a very important strategy for one to consider, especially for people who may have taken loan at a higher interest rate. Suppose today I'm not getting any loan which is less than 9.5%. So let me take it at 9.5% from wherever I get. After 2 years, I realize that my profile has gone up, my score has gone up, my income has also improved. What I can do is I can apply and go to another lender, and which can give me at a lower interest rate. Maybe they might be able to give me at 8.5% rate. So I can just shift my loan from one lender to another lender, which could be from one housing finance company to another finance company, or it could be from one housing finance company to another bank, or it could be from bank one to bank two. Wherever I'm getting the best rate, best value, I can shift there. But don't do this very often. Typically, in the tenure, you might do once or twice in the lifetime of a home loan. I would prefer that if you have gotten at a higher rate, wait for 1 2 years and then do a balance transfer and then stick to the next lender wherever you are. Regular monitoring, you monitor your payments, your financials, try to save more and more. If you save more, you will be able to pay your loans and close them much faster. Now we'll come to a master strategy that has worked personally for me in my life, which is step up EMI. So, like all of you know about SIPs, so EMIs are like SIPs, right, where the money is going out. But as everyone recommends that you should not keep fixed SIPs forever, you should do a step up SIP where if you start by 5,000, next year you can do 6,000, next year after you can do 7,000. Similarly, if you increase your EMI in your housing loan slightly every year, and हमारी salaries बढ़ती हैं, right? हमारी salaries go up every year, maybe by 5% or 10%. IT में हो तो maybe 5%. In some other sectors, it could be 10%. So you can increase your EMIs also just by going to the bank and increase your EMI. If you do that, if you kept your EMIs constant, you will end up paying 66 lakh rupees on a 25-year tenure home loan. But if you just increase your EMI by 5% every year, from 38,000 to 40,000, just 2,000 rupees का difference है. You will save nearly 35 lakhs on your home loan, and you will close your home loan also not in 25 years. You might actually close it down in just about 12, 13 years. And if you increase it by 10% every year, you will save nearly 35 lakh rupees, and you will be able to close it perhaps in 11 years itself. So not only you close the loan faster, but also you save so much of interest rate. So this is a strategy that has personally worked for me. I've taken 2 home loans in my life till now, and in both places I realized it later. But whenever I realized it, I started implementing it, and I saw these benefits. So definitely, this is one recommendation that I'll have for you. And now we will open it for Q&A.
Wow. So I must say, although I come from a finance background, this was a lot of new information for me as well. And I'm sure everyone else must have derived great value for this.
Sure.
So thank you so much, sir. And we have a lot of questions coming up. So let's get started with the questions.
Okay, sure.
So Nidhi is asking, if HFC and bank rates are similar, what should one go with?
So if bank and HFC rates are similar, everything is same, you have to look at other parameters. You have to look at charges, you have to look at fees. Is there any other term benefit that you are getting? Generally, going with bank would still make more sense. like one of the reasons that I would comment on is that if there is a rate change by RBI, the rate change will be affected much faster in case of bank. So I would say bank.
Bank, exactly. Okay, so Khushi is asking what should be an ideal credit history to go for home loan? Is 7 to 10 years enough? And she's planning to buy a home next year.
So I think 7 years of credit history is fantastic. Even if you have 3 to 4 years of credit history, that is good enough for one person. What is most important is the credit score on that. So if you have credit score of 750 right now, if you can do some work on your credit score and take it to 800, you might get that additional advantage on your interest rate. So think about credit score directly on that and see how you can work on that. And there are counselors who can actually advise you on how to take that, and you can take their help.
Right, awesome. So Sundar is asking, please explain the difference between fixed interest rate and floating interest rate on home loans. So I think this we have already covered.
Okay.
But if you could just briefly explain.
Sure. So fixed rate, like I said, is fixed for the tenor. So if you took a loan at 9%, that 9% will stay same over 10 years if that is the tenor of the home loan. But if you've taken a floating rate, today it might have been 10.25. But if RBI cuts the rate, maybe it will go to 10 in next year. If RBI further cuts the rate, it might actually become 9.5. It might even become 9. It might go even to 8.5 over the 10 years.
Right. So it is usually preferable to take a
Floating
floating
rate, especially when the interest rates are uncertain.
Right. Okay. So Manish is asking, if I'm planning to buy a home and currently I'm in an corporate employee. I'm a corporate employee, but soon after 2 to 3 years, I'm going to start my own agency or a startup. Will that affect my impression on bank loans or regarding my stable income?
Sure. And that's a great question. And I think a lot of us go through that same thing. And I can tell you my personal example. I used to be employed and then I switched over to be a self employed person.
Right.
So, when you're taking a loan and for next 2 3 years, if you're going to be in the stable situation, I think that's a good sign for a bank because bank, of course, like things can change over 20 years, so nobody can predict that. But the important thing is, if you are moving from corporate employee to self-employed, you should definitely do a proper budgeting, a proper emergency fund, and properly plan for EMI repayments. Because when you're running your own business, you can see ups and downs, but you should not be in a situation where you're defaulting on your loan. I think that's going to be the most important for a bank. So you should do your own personal calculation. I think bank will not see it negatively unless you are looking for an extension loan or a top-up loan. That is when they might increase your rate. But otherwise, I think you would be safe as long as you're paying your EMIs on time.
Right. I hope that answers your question, Manish. Manju is asking, is it wise to foreclose the loan after you've reached half the tenure?
Especially for home loans, I would not personally recommend that because today, like getting a loan at say 8 9% for home loan purposes is very difficult, and that's like a very lengthy process. So you can continue doing that, and like I also mentioned that there are tax benefits on home loan interest, so you can enjoy those benefits also, which are not available for other kind of loans. So, and we don't buy houses like very often. So unless you are in a real need to foreclose it, only then do it. But otherwise, my suggestion would be to let it continue and use that money for other productive purposes. And you can consult a financial counselor who can actually advise you and create a budget plan for you.
Okay, awesome. Nikhil is asking, will I get any benefits if I make my sister as a co-payer?
Absolutely.
Right.
Absolutely. So it has to be one, it has to be like a blood relative. You can't bring in anyone just to get the women borrower benefit. So a sister, most often mothers and wives work very well, but sister can also work well. The only matter that you should consider while you're talking about sister is if sister currently is not married and she gets married, then her financial situation could change. Her decisions will be slightly different because her husband will also have some influence on her financial matters. So do consider that because home loan is a 20-year matter. You can't take her out from the financial liability. So that's why mother and wives work much better than sister. But you can definitely consider as long as you have thought through.
Right. So you can consider your sister. Karunakara is asking, when should one consider loan transfer strategy?
Okay. So I think you're talking about balance transfer. So the only reason, first reason should be that you are on a higher interest rate and your current lender, whether it's housing finance company or bank, is not reducing your rate, which is mostly available in the market. So if you think that your rate is not getting adjusted to the market, then you go and talk to a separate lender, understand what is the best offer available. If the current lender is able to match that, you don't need to shift. But if the current lender is not able to match, then you decide to switch. But do your mathematical calculations, because there will be some switching effort, some switching time, there could be some switching costs also. So do all that math. If net it is making sense, shift.
Okay. Bikash is asking, should we close a personal loan, maybe duration of 2 years, by taking a top up on a home loan?
Okay, so it could be a good choice because top up is usually at a lower rate as compared to your personal loan. But like I mentioned, in several cases, and do consider your charges on your personal loan. Personal loans typically do not allow foreclosure so easily, or there might be very high rates or high charges on closure. So, if again you have to do your calculations to understand whether your foreclosure makes sense or not. If foreclosure is making sense, then go ahead with it. But if it's not making sense, let it continue. You can take the top up loan for other purposes, but not necessarily to close your personal.
Correct. Awesome. So we'll take the last question for the day. Kuldeep is asking, what about OD limit? Does that impact our credit score? People usually take it as a backup amount when required.
Great question again. So OD limit, for people who may not know, is an overdraft limit. So it's like it's another credit product that is not usually available to everyone, but either business people take it or even individuals can get it on their savings account, on specific type of savings account. So if you get it, there is definitely an impact on your credit score, only to the extent of what you use. Even if you have a OD limit of 5 lakhs, but if you're using only 1 lakh, that is what will cause the impact on the credit score. But if you are repaying on time for your OD limit, then also it does not have a negative impact. It may have a positive impact. So if you have an OD limit, don't worry about it. As long as your credit score is well maintained and you are repaying on time.
Right. Okay. So I think we should wind up with the questions, but don't worry. If you all have any more questions, you can put it down in the comments. And right after this session, along with Mr. Garg, our team will try to answer all of y'all's question. And if you wish to, watch the session again, it is again there available on our website, on our LinkedIn and Twitter. So you can rewatch it whenever you wish to. Some of the questions are also quite personal, and I would suggest it's best to book a consultation with one of our qualified for financial advisors to get a personalized advisory for you. All you need to do for that is download our One Finance app and book a consultation within a few clicks. So I think we should wind up for the day,
Absolutely.
and I'm sure it has been a quite fruitful session for everyone. So yeah, sir, thank you so much once again.
Thank you. I
For-
really enjoyed that. Thank you very much.
Great. And thank you everyone for staying till the end, and have a good day and a great weekend. Thank you.
All right. Thank you. Bye.